Welcome, and thank you for joining us for today's webinar, What the Fortune 500 Can Teach Middle Market Companies About Business Insurance. Now it's my pleasure to introduce our speaker, Bob Phelan. And Bob, can you advance to the next slide, please? Very good. A little bit about the technology before we begin. Your lines are muted for the duration of the webinar, but you can ask questions at any time in the question box. Now, let me introduce our speaker, please. Bob Phelan. Bob is the author of 2 books, most recently, The Cost of Ignorance, What You Don't Know About Performance-Based Insurance Can Save Your Company Millions. He's a 37-year insurance veteran. He's the CEO of the Litchfield Insurance Group, and he lectures nationally on insurance-based topics like the one today. Bob, the floor is yours.
Good afternoon. Thanks for joining me today to hear a little bit about this innovative idea that I've created in my book, and it's called Performance-Based Insurance. The title of the seminar is What the Fortune 500 Can Teach Middle Market Companies. So what we're going to do in this program today is give you a peek inside the world of the Fortune 500 and how they buy insurance. You can see on the slide, why should we listen to them? What does the Fortune 500 insurance buyer know that we don't know? And I guess the answer to that for most middle market companies would be a lot. They know a lot more than you know about how to buy insurance. They've got departments of people who specialize in buying insurance, as you can see here. We've got $1 trillion worth of profits from the Fortune 500. They're huge. These are all household names that I'm sure are familiar to you. They're worth a lot of money, and they have a lot to protect. As you know, as an insurance buyer, insurance is about protection. And what the Fortune 500 have learned is what's the most efficient way to protect the assets of our company. How do I go out and buy workers' comp insurance in the most efficient and cost-effective way possible? They've learned how to do that over many years, and what I'm here to share today is that these concepts over the last 20 to 30 years have been adapted to middle market companies, where you can really buy insurance in the exact same way that Apple Computer and Exxon and Walmart buy their insurance. It's a little different, as you might imagine, because of the size and the scale difference, but it's essentially the same concept. And it's what you'll hear from me today. It's what my book was based on, this concept of performance-based insurance. So what can we learn from them? They don't buy insurance the old-fashioned way. They don't buy insurance where the insurance company pays for the first dollar of coverage. By example, if you have a $50,000 workers' comp claim today with your company, your insurance company is going to pay that from the first dollar. You're not going to pay any of it. And what the Fortune 500 have learned is that's inefficient to buy insurance that way. It's inefficient for the insurance company to pay for the smaller, more frequent, more predictable types of losses. Because for those types of losses, it's possible for any company to hire an actuary and figure out how much risk they have, and figure out how much cash they need to allocate for that, and then to buy insurance for the more severe and unpredictable claims. And that's the basis of performance-based insurance. It's estimated right now that when you gather together all the businesses in the U.S., that 50% of all that premium is performance-based. Large percentage of that is the Fortune 500, actually the Fortune 1000. Companies that have annual premiums of $1 million or more are typically in a performance-based program. Not always, but they're typically in a performance-based program. So those are the larger companies that accumulate a lot more premium. But as I have learned, there is a groundswell of middle market companies that have learned the concept of performance-based insurance and want to adapt their insurance program to perform the same way. So what is performance-based insurance? Let's compare it to traditional insurance, first of all. As I mentioned earlier, You pay, I'll use an easy example. You pay $300,000 a year to the insurance company. And whether you have $1 million in claims that year or 0 claims that year, you pay $300,000. It's traditional, subsidy-based, guaranteed cost insurance. The cost is guaranteed regardless of your performance. So let's say you're a high-performing company. And what I mean by that is a company that has a low level of losses, a consistently low level of losses, because they have a strong safety culture. They manage their claims. They get people back to work quickly. They can rely year in and year out on performing well. Well, if you're paying $300,000 a year and you're performing well, and I'll use an example of $50,000 in claims, what happens to the other $250,000? Well, since you have a guaranteed cost insurance program with your carrier, they keep the other $250,000. And what do they do with that other $250,000? Do they pile it into the profit column on their profit and loss statement? No, they really don't, because in their portfolio of companies, they have a lot of poor performers, and they spent more than the $300,000 that they paid in. Maybe 4, 5, 6, 7, 8, $1 million. They have bad years. They have people that get injuries. They have vehicles that cause accidents, and there's a lot of those companies who are poor performers. They take your money and use it to subsidize the poor performers. That's where most of the excess money goes. So I ask you a very simple question. As a middle market company, if you had an option, why would you want to do that? Why would you want to subsidize your competitors? You've worked hard. You've created a strong safety culture. You're doing really well. Why would you want to give that money away to anybody? It's almost like a thief reaching into your pocket and stealing your money, stealing those insurance dollars. You don't get to keep them. Performance-based insurance changes all that, because it's a pay-for-performance program where you get an opportunity to earn all or part of that excess money back. Why do these Fortune 500 companies use this approach? It's simple. They don't want to subsidize their unsafe competitors. They, as you might imagine in a big company, they have lots of reasons that they have to have a very strong safety culture. If they have serious accidents, they go right on the front page of the paper. Government agencies, OSHA and others come after them. Regulators come after them. So it's common with large companies to have very strong safety cultures. And the last thing they want to do after making that large investment is to subsidize others. The other big part of it, and probably the more important part of it, once you get past the philosophical thing of I don't want to subsidize somebody else, is that you can earn significant dividends. The companies that we have in middle market performance-based insurance programs routinely save 25 to 35%. And some of my top performers save 50% or more in a given year. They really adapt that safety culture, and they knock it out of the park. And as you can imagine, I'll go back to my example. I'll be consistent with my example. If it's $300,000 and you get 150 back, when you do that consistently over a 6, 7, 8 year period, you save $1 million. There's no other way you can save that kind of money buying insurance other than performance-based. So there's other features to performance-based program. You get more flexibility in the coverage you buy and how the plan is designed. Instead of getting an off-the-shelf traditional insurance company product, which is the same for everyone, you get something that's a little more unique to the needs of your company. You also, in many forms of performance-based insurance, you know the companies you're sharing risk. And when you see in the parentheses here, it says Lloyd's, and that's a abbreviation for Lloyd's of London. If you go back to, I think, the 1600s, John Lloyd was a guy who had a coffee house down the docks in London. And it was a coffee house frequented by all of the ship owners and people who were in the shipping business. And as the cargoes started to grow and become more valuable, one day one of these ship owners said, geez, I've got a lot of risk out there at sea. I've got 4 ships out there right now, And if there's a big storm, I'm not going to be able to recover from the financial losses that I take. And he went to his buddies sitting around the tables there in Lloyd's coffee house and said, why don't we share risk? You know, insurance wasn't invented by Lloyd's, but the modern day concept of sharing risk that we know really was started in that coffee house. And the little interesting anecdote about that is that when they first started to do this, one of these ship owners took the name of his ship, the cargo, the destination, the time at sea, wrote down all those characteristics on a piece of paper, and pinned it up on the wall. And he then invited the other ship owners to take some of that risk. And they all wanted to do this and help each other. So they would go up and write on there 10% or 5% or 7%, and they say, we'll take that part of the risk. And they would write their name under the name of the boat. And that's where the term underwriting comes from, underwriter comes from. And Lloyd's of London to this day still operates that same way, where somebody walks around the room and different underwriters put a percentage of how much risk they want to take on an individual account. You also have risk management, and I use the concept of owning your risk. If you enter in a performance-based program, now you've got skin in the game. Now you need to own your risk. You haven't just transferred your risk to an insurance company where they're on the hook for all of it. You own part of it. And what owning your risk means is that you take responsibility for it. And primarily what that means is safety. If you don't take responsibility for safety and you don't own your risk, then performance-based insurance is not for you. If that's your attitude, you should get off the webinar right now, because traditional insurance is the only way for you to fly. You're going to have ups and downs. You're going to, instead of just spending that $300 one year, you're going to spend $400 another year or $500. And you don't want to be in the game where you put that kind of capital at risk unless you own your risk and you control it and you have a real dedication to safety. This is the biggie, this next bullet point. You keep the profits. Right now, as I mentioned earlier, you are using your profits to subsidize others, and what remains, and there is always some that remains, it goes on to the carrier's balance sheet. The insurance company is the one that keeps those profits. If you go performance-based, you can be in a program where you get 100% of the reward for your favorable claims experience. So if you own your risk and you're confident that you can consistently control it, this is the only way to fly. You all of a sudden, instead of that 300, think of it this way. Even if you only got 50 back, it's 50 that you don't get back now. And 50 is another employee. 50 is another piece of equipment. It's real money. And it might average a lot over the years. Some years it might be 200, some years it might be 50. But any amount is a return to you that you don't get now. Here's just some bullet points that I put together that compares the fully insured on the left, or what I've been calling a guaranteed cost insurance. You pay the $300, that's the most that you pay, versus performance-based, you pay the $300. There's some upswing to this. I don't want to mislead you. In a performance-based program, there's also some risk that you can pay more, and you might even have assumed that already. I'm going to say in my $300,000 example that you might have $50,000 of upside swing versus $150,000 of downside swing. And what I tell my clients is that every once in a while, no matter how safe they operate, they're going to get an unexpected claim, and they might pierce through that upper layer. But what you need to know is if you do it right, you're still going to save that average of 25 to 35% a year. And that's the only way to look at it, is with a long-term mentality. So you pay for performance. I'm looking at the right-hand column now. You have full control of your insurance destiny. And what I mean there is if you're an insurance buyer that's been doing this a long time, you know that business insurance goes through market swings, where you can go 2 or 3 or 4 years where your premiums are equal or going down, and then all of a sudden you get an unpredictable market upswing where your broker comes out to meet with you at renewal and says, I'm sorry, but there's natural disasters all over the world, and the reinsurance industry is losing money, and it's being passed down to us, and I got a 25% rate increase for you. When you're in a performance-based insurance program, that doesn't happen. Your premium is based on your own individual loss experience. It's not based on the suffering of all the other people out there buying insurance. You earn the financial rewards. And one other thing, for those of you who go out to bid, if you do it with any regularity, it's a lot of work. You've got to go through the application process. You've got to sit with your broker. You've got to analyze bids, and you've got to go through gathering loss runs. There's a lot of work. If you join a performance-based program, you're not market priced anymore. You're priced based on your own individual claim experience, so you never have to go out to bid. And I mean that sincerely. Once you go performance-based, you never go out to bid again. So this is a simple graphic example of what we've been talking about. Traditional insurance on the left. 30% of the cost of your premium is the insurance company's overhead. They're a company just like yours. You've got overhead. You've got people, administrative, legal, actuarial, claim, underwriting, risk control. They've got all those different pieces, and it adds up on average to about 30%. So the other 70% is what's left over, and what I indicate here, most of that money is used to subsidize others. When you turn this formula on its head with performance-based insurance, it's got the same level of overhead, maybe a little bit more depending on the program that you get into, and you've got that 70 cents or 70% of the dollar of potential return. But that's it right there. You know, if I were to show one slide today and explain how this thing works and how you can benefit from it, it would be this slide right here. It's the potential return of 70%. When you own your risk, control your losses, strong safety culture, you have that potential return of 70%. You have it every year, year after year, and you never have to go out to bid. This is an important slide too. It's a pyramid that I like to describe here. It's a 70-30 insurance principle. That 70-30 that you want to take advantage of. This is how you take advantage of it. The safety piece is what I've been referring to as owning your risk. You own it, you're responsible for it, and the numbers hold you accountable for it. The other piece, which is often neglected, is what we call injury management. Many insurance buyers like yourself might think, if I have a $30,000 workers' comp claim, it doesn't matter who my insurance company is, who my claim adjuster is, who my broker is, it's a $30,000 claim. And nothing could be further from the truth. Claims, particularly workers' comp claims, are mismanaged every day. And you need some group of individuals performing an oversight function in injury management. You don't want to turn a $10,000 claim into a $50,000 claim or a $50,000 into a $100,000. You want to manage those claims to the lowest level possible. And that's where the injury management function is very important. And then you buy a performance-based solution, because why do you want to work hard, own your risk, and manage injuries if you don't get any benefit from it, and all that extra money just goes to subsidize your competitors? That's crazy. You've got better things to do with your time and your money and your resources than manage safety so other people benefit. So this is the three sides to the triangle, and you need all three to get the maximum benefit. Could you be a little weak on safety and still get a benefit? Yes. Could you miss injury management or not maximize it to the fullest and still benefit? Yes. But you're going to maximize your potential return if you've got these three pieces. I'm going to show you some case studies very briefly here. I have a nursing home chain that pays, at the time of this case study, I'm going to say $7 million a year in premium, very large company. And when we met them, they had all traditional guaranteed cost insurance, one on every nursing home they owned. We formed a captive insurance company, which is a form of performance-based insurance. We enhanced their safety culture, and within the first year, they got a 30% return on their investment. So this is a company spending millions and immediately saving millions, and they really haven't begun to save what they will, because the safety culture piece is still in process, it's still in development, and because they've got 4,000 employees, it's going to take a while to turn that ship around. But when they finally fully get that culture embraced onto their company, they're probably going to be paying half price what they used to pay. So that's an interesting case study. This is a regional contractor that have had in a performance-based insurance program for a long time. So they were benefiting. But I told them one day, you know, you're not benefiting as much as you could. You don't have the safety strength. You don't have the injury management. And they kind of didn't want to listen to me. They said, you know what, we think we're just going to get $250,000 of claims every year. And we don't think there's that much we can do about it. We've tried, we've done this, we've done that. Well, I showed them some other case studies of other contractors and some statistical analysis. And they looked at it and they said, you know what, maybe we can be one of those top performers. So we're going to own our risk. They took full responsibility for their risk for the first time. And as you can see in the bullet point at the bottom, 50% return on their investment. It's actually been incredible. Over the last 4 years, their traditional guaranteed cost premium would have been $4 million, and their actual cost is only $2 million. So there's real power to performance-based insurance when it's used properly. Last case study, there's something, and it's really what we promote the most for middle market companies. It's called a group captive, that second bullet point. These folks joined a group captive, I think, about 17 years ago. And what a group captive is, it's forming an insurance company around a group of middle market companies. And there's usually consultants that do this. They find 10 or 12 companies to form the core group, and then they use brokers like us to build it over time. These small insurance companies called group captives can range in size from 25 companies to 350 companies. And they work just like a mini insurance company, but the only difference, based on the slides we saw earlier, there's 30 to 40% overhead. You get the rest of the money back. And so it works just like that. It's a mini version of what the Fortune 500 insurance companies use. And if there's anybody on the call today who's pays over $1 million a year, there's a range of options for a company your size that gets you almost identical to the Fortune 500. If you're under $1 million, it's a junior version of the same thing, not exactly the same thing. There's a little more fixed costs associated with it. But other than that, it performs equally well. And as I said earlier, whether you get $25,000 back, $50,000 back, or $100,000 back, it's money you're getting back that you weren't getting back before. And I think that's important to understand. And the more you own your risk, the more you get. So that's all for today.
Thank you very much, Bob. And for anyone who's attending, if you're interested in getting a copy of The Cost of Ignorance, just send us a quick chat or a question, and we'll be glad to provide that to you, a complimentary copy. Bob's contact information below, 860-761-7201. And if Bob could advance to the next slide, we'll give you the full contact information. We had many people who attended today, many different types of middle market companies. We hope you got everything that you wanted out of this webinar. But if you have additional questions or would like to know if you're a good candidate for performance-based insurance, please contact Bob Phelan at Litchfield Insurance with this information, and he'd be glad within 10 or 20 minutes to give you a quick review and determine if you're a good candidate for this important type of insurance program. With that, this web seminar is now ending. We'd like to thank everyone who attended, and would also like to thank Bob Phelan for sharing the time and information today. You all have a great day.